Picture this. You use your credit card for something normal. Maybe groceries, maybe a flight, maybe a new laptop for work. You already have the money to pay for it. You wait for the bill, pay it on time, avoid interest, and move on with your life feeling responsible. Then a few days later, you check your credit monitoring app and your score dropped. Not by a little, by enough to make you stop and think, what did I do wrong? And that's the frustrating part. Because from your point of view, you did everything right. You paid on time, you didn't miss a payment, you didn't get charged interest, you acted like a responsible adult. So why did your credit score still go down? Because paying on time and looking good to the credit scoring system are not always the same thing. And that is where a lot of people get blindsided. Today, I'm going to show you the real reason this happens, the one date most people completely ignore, and how a small timing change can make your credit profile look dramatically better without spending less money or taking on more debt. If you want to understand how money systems actually work, instead of just guessing your way through them, you're in the right place. Let's break it down. First, here's the mistake most people make. They assume credit bureaus are watching your account in real time. They assume that if you pay your card today, the system instantly updates and says, great, this person owes less money now. That would make sense, but that's not how it works. Your credit score is not built from a live video feed of your financial life. It is built from snapshots. Think about it like this. Imagine someone takes one photo of your room every month. Not after you clean it, not after you organize it, not after everything is back in place. They take the picture at one random moment while clothes are on the chair, boxes are on the floor, and your desk is a mess. Now, imagine that one photo is the only thing anyone uses to judge how tidy you are. That is basically how this part of credit reporting works. Your card issuer usually reports your balance based on a specific moment in your billing cycle, not based on how virtuous you feel after paying the bill by the due date. And that one timing difference is where all the confusion starts. Let's make this simple. Say your credit limit is $5,000. During the month, you spend $2,000. That's normal, nothing crazy. Now, let's say your billing cycle closes on the 28th. On that day, your balance is still sitting at $2,000 because you haven't paid yet. You're waiting for the statement, like most people do. Then your due date comes maybe 3 weeks later, and you pay the full amount on time. No late fee, no interest, no problem. Except there is a problem, because the balance that may have been reported to the credit bureaus was the $2,000 balance sitting there on the statement closing date, not the zero balance after you paid the bill. So even though you paid on time, the system may have already recorded you as using 40% of your available credit. And 40% is not a flattering number in the eyes of the scoring model. That is the part people miss. Paying on time protects you from fees and interest. The statement closing date often determines what utilization gets reported. Those are not the same date. And if you don't understand the difference, your score can move in ways that feel unfair. Now, let's talk about what utilization actually is, because this is the lever behind the whole issue. Credit utilization is just the percentage of your available credit that you are using. That's it. If you have a $1,000 limit and your reported balance is $300, your utilization is 30%. If your limit is $5,000 and your reported balance is $2,000, your utilization is 40%. Simple math. But the scoring system reacts to that math in a very emotional way. When your utilization gets too high, the system starts reading that as risk. Not because you missed a payment, not because you're irresponsible, but because high balances can signal financial stress. The model is basically asking, how dependent is this person on borrowed money right now? And when the answer starts looking like a lot, your score can drop fast. That's why someone can be perfectly on time and still see their score go down. They didn't get punished for paying late. They got punished for having too much balance reported at the wrong time. That is a completely different problem. And once you understand that, the whole thing starts making more sense. Now, here's where it gets even interesting. A lot of people think, fine, then I'll just pay everything to zero all the time. That sounds logical. Low is good, so zero must be best. Not necessarily, because there's another subtle distinction people miss. Reporting a balance is not the same as carrying a balance. Carrying a balance means you leave debt unpaid past the due date and get charged interest. Reporting a balance simply means the statement closed while a small amount was still there. Those are two different things. You could let a tiny balance report and still pay it in full by the due date, which means you pay zero interest. That's important because the scoring system often likes to see that you are using credit lightly, not ignoring it completely, and not leaning on it heavily. In other words, the ideal picture is often not maxed out and not completely inactive. It's controlled activity. Small usage, clean management, low reported balance. That tends to look stronger than chaotic spending followed by last-minute cleanup. So, what should you actually do? Here's the practical fix. Instead of treating your due date as the only important date, start paying attention to your statement closing date. That is the date you want to learn. Not guess, not assume, actually learn. Because once you know when your card issuer takes that snapshot, you can control what the snapshot looks like. Let's say your statement closes on the 28th. If your balance is $1,800 on the 28th, that's the picture the system may see. But if you make a payment on the 25th and bring that balance down to, say, $100 before the statement closes, then the snapshot looks completely different. Same spending habits, same card, same money, different timing. And timing is everything here. That's why two people can behave almost the same way with money and still get different score movements. One person waits until the due date. The other person pays before the statement closes. One looks heavily utilized. The other looks disciplined and low risk. Same real life, different reported story. That's what credit reporting does. It tells a simplified story about your financial behavior. Your job is to make sure the story being told is accurate and favorable. Now, I want to pause here because this is also where people start overcomplicating things. You do not need to obsess over every swipe. You do not need to make 5 payments a week. You do not need to treat your credit card like a bomb. This is not about panic. It's about understanding the system well enough to stop getting surprised by it. For most people, the simple rule is this. Keep your reported utilization low, especially if you're planning to apply for something important soon, like a car loan, apartment screening, or mortgage. That is when every point matters more. And if you want a practical target, many people aim to keep utilization under 30% and even better under 10% when they want to look especially strong. The lower the reported balance relative to your limit, the cleaner the signal. But there's another trap here. Let's say you have multiple cards. Your overall utilization matters, but individual card utilization can matter too. So if you have one card with a tiny limit and you nearly max it out, that can still hurt even if your total available credit across all cards is decent. That's why people sometimes get confused. They look at all their accounts combined and think, I'm fine, but one card is screaming distress, and the system notices. So don't just look at your total debt, look at where the balances are sitting. A small card carrying a high reported balance can create more damage than people expect. Now, let's talk about the emotional side of this, because this is the part nobody explains. When your score drops after you paid on time, it feels personal. It feels like the rules are fake. It feels like the game is rigged. And honestly, I understand why people feel that way, because most of us were taught one main rule: pay on time. And that rule is still important. It protects your payment history, which is a huge part of your score. But paying on time is not the entire system. It is one part of the system. And if you only understand one part, the rest can still hurt you. That's why financial progress often feels confusing. People are following the rule they were told mattered most while ignoring the part no one bothered to explain. Not because they're careless, because the system is full of invisible mechanics. Once those mechanics become visible, your choices get smarter. So, here's the cleaner strategy. Number 1. Find your statement closing date for each card. Usually you can find it in your account details or on a past statement. Number 2, a few days before that date, check your current balance. Number 3, if the balance is high relative to the card limit, make a payment before the statement closes. Number 4, let the statement generate with a low balance. Number 5, then pay the remaining statement balance by the due date so you avoid interest. That's the game. Not magic, not a loophole, not a scam. Just understanding how the reporting cycle works and using timing to your advantage. And one more thing. Do not confuse this with trying to artificially run huge amounts of money through a tiny credit line over and over again. That can start looking suspicious to issuers. If you're constantly slamming into your limit and having to pay it down multiple times just to keep using the card, that's usually a sign you need a higher limit or a different setup, not more clever timing. The goal is not to look manipulative. The goal is to look stable. That is what strong credit is really about. Stability, consistency, low friction,
clean repayment behavior. And once you understand that, the weird score drops start to feel a lot less mysterious. So, let's bring this home. If your credit score drops even when you pay on time, it usually does not mean the system ignored your good behavior. It means the system saw a different part of your behavior than the part you were focused on. You were focused on the due date. The system was focused on the reported balance. You were thinking, I paid responsibly. The model was thinking, this person was using a high percentage of available credit when the snapshot was taken. That's the disconnect. And once you fix that disconnect, you stop feeling random. You stop feeling punished every time your score moves. You start seeing the system for what it is: a set of rules, a set of dates, and a set of signals. Learn the signals, and the results get a lot more predictable. So, if you've ever watched your score drop and thought, that makes no sense, I paid on time.
So if you've ever watched your score drop and thought, that makes no sense, I paid on time, now you know the real reason. It wasn't just about whether you paid, it was about when the balance was reported. And that small detail can make a much bigger difference than most people realize.